All right, if you make $100,000 a year and this house pops up in Seattle, Washington, listed at $625,000, would you be able to buy it? Would you be able to qualify for the loan? What kind of monthly payment would you see? We're going to walk through those things here. We're going to walk through two different scenarios in this on this house. One scenario where you're able to put about 10% down, and one scenario where you are able to put about 20% down. We'll look at two different real quotes showing the numbers there. For those two different scenarios, we'll show you what your monthly payment would be, what ballpark of an interest rate we might be looking at here early in March, here about mid-March now, and I will show you all the cash you're going to need to have on hand for those two different scenarios with your down payment as well as all closing costs you might have. And then I'll talk about whether you'd be able to qualify for the loan, whether the lender would give you the loan if you make around $100,000 in income. So we'll go ahead and look at that. My name is Landon Buteau. I am part of a mortgage team based in Bothell, Washington. And this channel exists to make the early stages of just poking around at houses and thinking about buying a house much more productive, much more fruitful, and give you much more reliable information. So let's go ahead and look at those two quotes. All right, so here are the two quotes we're going to look at. On the left here is the 10% down scenario, and on the right is the 20% down scenario. So in both of these, I'm assuming you are not a first-time home buyer. Which if you are a first-time home buyer, that can sometimes get you access to a little bit better pricing. But here we're just using these 30-year conventional fixed loans. We're not using a special first-time home buyer loan. However, the assumption we are making on your credit is that you are 740 credit score. Usually a little bit higher credit score improves various avenues of your pricing. So if you're a little bit below that, you can adjust a little bit. Maybe if you're above that, you might be able to adjust a little bit. The increments don't get a ton better beyond that, but they do get slightly better. So this is it's good credit. It's really good credit. It's probably a little bit above average, but it's not an uncommon situation to be working with 740 credit score. So we'll start by looking at the 10% down scenario, walk you through the numbers here, and we'll talk about how the 20% down scenario is different. Right off the bat, you can see in the 10% down scenario, the monthly payment is $4,414. That's a pretty high monthly payment. So if you're making $100,000, you can pretty quickly kind of figure out the math to see if that's something you could even afford, you'd be comfortable with. And that 10% down at this price point of $625,000, it leaves you with a pretty high loan amount, which you can see here. The loan amount is $562,500. So that's pretty steep. So the monthly payment is going to end up pretty high, especially now, where although they're not as high as they were the last few months, rates are still pretty high. So the components of this monthly payment, the breakdown of this is you have homeowners insurance, which I'm assuming homeowners insurance of $150 a month, which is a pretty reasonable estimate. You could end up below or above that. Just depends on your coverage and who your provider is, but that's a pretty reasonable estimate. Taxes of $470 a year, and I did grab these from the county website, so I'm using the actual tax number. And the home price is not cheap, and then it's in a high tax area. So those are hefty taxes that are adding to that monthly payment, and those are included here. But they add to just the already existing challenges of this monthly payment. Mortgage insurance here, $98 a month. Mortgage insurance is a fee you have to pay if you put less than 20% down, which in this scenario we are putting 10% down. The last component is principal and interest, and that's just a function of the loan amount and the interest rate. So down here, the interest rate you can see is 6.875, starting to come down a little bit from the last few months of being in the low to mid sevens. Hopefully those will keep going down. Again, this is mid-March. We'll see. This rate is not a guaranteed rate, and it's not. It depends on a lot of different factors, so it's certainly not guaranteed that you could get this rate. You might be lower, you might be higher. One important note about this rate is that it is using basically 0 points. Points are a fee you can pay to get a lower interest rate. Credit is the opposite of that. You see here, points are credit. Credit is a credit from the lender that they would use to cover some of your closing costs if you're willing to take a higher interest rate. In closing costs, we have about $12,600. That might be a little high, but it's a function of the area you live in, and it's a function of a ton of different things. What's closing costs, but the general ballpark that we tend to see is maybe $8,000 to $12,000 in this area with this price point, this loan amount, this kind of general picture. So that's not far off. The kind of go-to number that we use when we're just estimating in our heads early is maybe $10,000 or $11,000, and then that means total cash to close of $77,000 in this 10% down scenario, and that's a combination of your down payment of 10% and your closing costs here of about $12,500. So as far as qualifying, actually we'll come back and touch on qualifying once we've gone through both loans. So I can explain it one time through and then just talk about the two different numbers there. So let's look at the 20% down scenario. So again, right away, you can see the 20% down scenario. Obviously, you're going to have a significantly smaller monthly payment, which is $3,905. That is made up of 3 different elements instead of the 4 that come with the 10% down scenario, and that's because we made it to 20% down, we don't have to pay mortgage insurance. So that leaves the 3 components being homeowner's insurance, which you will have to get. That's not really a negotiable thing. Sometimes you can pay it separately, but almost always it's paid through escrow as part of your mortgage payment. So homeowner's insurance, taxes of $470 a month. Both of those are going to be the same because they're dependent on the house, not the loan. And then the principal and interest of $32.85. And again, that is a function of your loan amount here, which is $500,000 because you made it to 20% down, and your interest rate, which in this case happens to be the same. That's not always going to be the case if you go from 10% down to 20% down, but in this case it was just a function of your lender, what their rates are and what the going rates are in the market right now, and what's going on a given day. Again, points or credit 385. That's basically as close to 0 as our rate sheet would show right now, so no points there. And again, if you missed it, points are a fee you can pay up front to get a lower interest rate. And then down at other closing costs, it's basically the same, $12,353. Once again, that's a pretty reasonable estimate usually if we're just estimating a number off the top of our heads for closing costs in our area. For this kind of loan amount, it would be around $10,000 or $11,000. All right, so that leaves you with a total cash to close of $138,848. That is your down payment of 20% down, plus your closing costs of about $12,500 here. So that's the cash you would need to bring roughly for that scenario. So I want to talk about qualifying. I want to talk about what income it would take to qualify for this loan. So as I start talking about this, I'm not talking about affordability. Affordability is a question that you have to determine on your own or with your financial advisor. What's your comfort range? How much of a monthly payment can you take on when you make X amount in income? The second note I want to give when I'm talking about qualifying. So we're talking about when you make $100,000 in income. I'm going to be talking about qualifying income, $100,000 of qualifying income. So if you make, and the reason that distinction is important is because the way lenders figure out how much you can qualify for is a function of how much income you make that they deem usable. So just because you make, let's say you make $100,000 salary, and then you also have a little side gig where you make about $20,000 a year, or you make $100,000 a salary, and then your spouse works at a coffee shop where they make a little bit of income, but they only started recently, and it's variable hours. Well, the lender's going to look at that, and they're going to say, we can't rely on that income. There's no way we can use that income in determining how much you can qualify for. So what I'm going to be using is qualifying income. Now, generally, if you make salary, then all of that salary is going to be usable. And then sometimes even some of your bonus or insurance stuff might qualify as usable income. However, if you are making other types of income, if you're self-employed and you own your own business and that fluctuates year to year, or you are in sales and you make mostly commission, or you have variable hours, then any of those scenarios, then there's going to be a little bit more strict rules on the lender's part to figure out what they can use, what they will deem as usable income. So what I'm going to be talking about is usable income of $100,000. Now, the way that lenders figure out what monthly payment what loan you can qualify for is a function of what monthly payment you can qualify for. So they take what's called your debt to income ratio, your DTI, your debt to income ratio, which is your total monthly debts, and they divide that by your gross monthly income. So your total monthly debts in this top number, they take any other debts you have, your credit card debt, your student loan debt, car debt, whatever other debts you might have, and then they add that to your new proposed monthly payment, the monthly payment that would result from this loan scenario. They take that total number, any other debts you have, plus this new housing debt, and they divide it by your gross monthly income. That's your usable income before taxes. And if that number is less than 50%, then you're pretty much good to go for the most part. And specifically with conventional loans, which is what we're looking at, then anything less than 50%, for the most part, you're going to be pretty good to go. And so if we look at $100,000 in income and we say that's all usable, whether that's salary or whether that's you're right around $100,000 after a few years of sales and you've made that pretty consistently, or you're self-employed and you've made that at least that amount fairly consistently for a few years, then let's say that's the qualifying income. Then would you be able to qualify for these loan scenarios? So the way we have to figure that out is we take $100,000 and we divide that by 12 to see what your gross monthly income is. All right, so I just cheated and did a little calculation on my computer, and that breaks down to $8,333 per month. $8,333 per month. So if this, and so again, in figuring out whether you can qualify for this loan, another assumption I'm making is that you have no other debts. Because again, this top number, this number right here needs to be, it's your total monthly debts, any other debts you have. But what I'm just using is your housing payment. So this is assuming you have no other debts. If you take that number and divide it by your gross monthly income of $8,333, then it's going to be over 50% for this one right here, for the 10% down scenario. And it's going to be under 50% for the 20% down scenario, because 2 times 4,414 is 8,828. So this is what you'd have to be making in order to qualify for this scenario, which obviously if you're making $100,000, it's close, it's right on the edge. So if you're a little bit above that, you might be close, you might be there, but you would not qualify if you're right at $100,000. Whereas in this 20% down scenario, you've been able to knock off mortgage insurance, you've been able to knock down the loan amount significantly, and so now you have a smaller monthly payment, so you would only have to be making $7,810 a month, which is less than this. So you would be below 50% debt to income ratio in that 20% down scenario. So if you want to get a quote on a real house that you are looking at and get real numbers, if you want to start talking about what income, which of your income would qualify, how much of your income would qualify and be usable, please do reach out. Again, we're based in Bothell, Washington, but we do loans in Washington and Idaho. Again, we love to work with new people. You can check out what it's like to work with us, what our process is. There's a link in the description of this video. There's a link to a video explaining what it's like to work with our team, what our process is like. So please do watch that. And if it seems like a good fit, then you can reach out, or just go ahead and reach out right now. There's a link in our description as well to contact us, whether that's email, text, call, whatever works best for you. we'd love to serve you. So if that sounds valuable to you, please do reach out.